Hello and welcome everyone to today's webcast on hyperinflation. My name is Lucy Wright and I'm an Executive Director in the Global Corporate Reporting Services Group. I will be your moderator for today and we are going to go through an introduction to the principles of IAS 29 financial reporting in hyperinflationary economies. The session is aimed at those needing a basic understanding of the principles for entities in an hyperinflationary environment, as well as those working with group accounts that include hyperinflationary subsidiaries. As a reminder, we will ask a series of content and CPE verification polls throughout this webcast, and if you're interested in receiving CPE, you will need to respond to all those polls to qualify. For those attending the live webcast, if the polling question does not appear, you may need to turn off your pop-up blocker, ensure that you are not in enlarged slide mode, and set your zoom control to 100%. Also, the slides are available to participants in the resources icon if you would like to download them. We welcome any questions and comments throughout the webcast, so please do submit them as they come up. I have a great team joining me here today, so let's meet everyone on the next slide. Firstly, we have Sinem Oz. Sinem is an assurance partner in EY Turkey and a member of the Turkish IFRS desk. We're glad to have you, Sinem.
Thank you, Lucy. It's great to be here.
Our next presenter today is Peter Decker. Peter is a partner in Global CRS. He is also the Global CRS lead for the Foreign Currency and Hyperinflation Topic Experts Group. Welcome, Peter.
Thank you, Lucy.
And last but not least, we have Jane Watson. Jane is an associate partner in the Africa Financial Reporting Group, is the lead IFRS contact for EY Zimbabwe, and is the author of the International GAAP chapter on hyperinflation. Welcome, Jane.
Thanks, Lucy.
Now, let's move on to the next slide. So we're looking at slide number 3. So on this slide, we have today's main objectives for this webcast. And then let's move on to slide 4, where we can see today's agenda. So for today's webcast, we will focus our discussion around the key concepts and indicators of hyperinflation. We are also going to discuss the steps to follow to apply IAS 29 in the accounting records of the hyperinflationary subsidiary. And then lastly, we will briefly discuss the considerations around consolidation of a hyperinflationary subsidiary. Next slide, please. In this section, we are going to provide an overview of what hyperinflation is, what the indicators of hyperinflation are, and a list of hyperinflationary countries. Next slide, please. Moving on to slide 6. So, Peter, can you explain to us what hyperinflation is, please?
Sure, Lucy. Hyperinflation, that's a state where inflation has reached such levels that the local currency is no longer a useful measure of value in the economy, and the general population actually prefers to hold its wealth not in the local currency, but preferably in a stable foreign currency or non-monetary assets.
Thanks, Peter. So moving on to the next slide, how would you know when the currency of a country has become hyperinflationary?
So IAS 29 does not establish an absolute rate at which hyperinflation is considered to exist. Instead, judgment is required in determining whether or not restatement for hyperinflation is necessary. And on the slide, we have a non-exhaustive list of hyperinflation indicators that are based on the characteristics of the economic environment of a country, and which considers factors such as the fact that the population prefers to keep its wealth in non-monetary assets or a relatively stable foreign currency. That also means that amounts of local currency held are immediately invested to maintain purchasing power. The general population regards monetary amounts not in terms of the local currency, but in terms of a relatively stable foreign currency, and prices will often be quoted in that currency. Then also, sales and purchases on credit take place at prices that compensate for the expected loss of purchasing power during the credit period, even if that's a very short period. Interest rates, wages, and prices tend to be linked to a price index. And finally, the cumulative inflation rate over 3 years is approaching or exceeds 100%. Now, this judgment is not made on an entity-by-entity basis, but rather the decision is made by consensus following discussions by regulators, preparers, and auditors. Next slide, please. Hyperinflation, it is an issue in a growing number of jurisdictions at this moment. And in April and October each year, we publish an IFRS developments on hyperinflationary economies, which lists countries that are considered hyperinflationary for IFRS purposes, or that should be monitored for hyperinflation. In particular, I would note that Turkey is considered hyperinflationary for reporting periods ending on the 30th of June 2022 and thereafter. And in addition, Ethiopia has also become hyperinflationary, and Sri Lanka, which has been added to the watch list, is likely to become hyperinflationary in the coming months. An entity is required to apply IAS 29 if its functional currency is the currency of a hyperinflationary country, and it should apply it from the beginning of the period in which the existence of hyperinflation is identified. So please read our October IFRS developments, which was published today. It provides a very helpful guidance and is available on EY Atlas and ey.com/IFRS. Next slide, please, and back to you, Lucy.
Thanks, Peter. Let's introduce our first polling question here, which is, if you have a client with a hyperinflationary subsidiary, what is the expected financial impact of the application of IAS 29 at a group level? And you have 5 options. Option A, material; B, insignificant; C, no impact; D, not yet determined; or E, not applicable. So please decide which one of those statements you think is most appropriate and submit your answers to us, and we will come back to the results of that poll in a few minutes. Moving on to the next slide then, please. Now, Jane, can you please take us through the objectives of hyperinflation accounting?
Sure, Lucy. The general principle of IAS 29 is that all amounts should be expressed in the monetary unit present at the reporting date, or more simply, adjusted for inflation since the date of acquisition. In this example, we have 2 parcels of land, both acquired a few years apart for 1,000 each. Prior to applying IAS 29, these would be reflected at the same value. However, as the purchasing power of 1,000 currency units was considerably higher several years ago, it's likely that the older property has a higher value today. Parcel 1 is therefore restated for the inflation since its acquisition and is restated in the scenario to 3,500. As the comparative period is also expressed in the monetary unit present at the current reporting date, the comparative periods include Parcel 1 at the same value. Parcel 2 will be subject to the same principles. It is restated for the 30% increase in inflation since its acquisition date. Next slide, please. In the next example, we see the impact of hyperinflation on revenue and cost of sales. In this instance, inventory was purchased and kept on hand for 5 months. Before the application of IAS 29, the entity reports a gross margin of a profit of 500, but this does not reflect the inflation for the holding period. Under IAS 29, revenue is adjusted for inflation from the transaction date of 1 December, which is the date that the value of revenue was last a reflection of a current price. However, the inventory sold was last expressed at a current price when it was purchased on 1 July, and therefore needs to be adjusted for inflation from this earlier date until the year end. We can now see that taking into account the cost of holding this inventory, this transaction has had a negative return.
Thanks, Jane. Moving on to the next slide, please. So staying with you, Jane, to apply the requirements of the standard, you need to gather a lot of data and perform some fairly detailed calculations. This looks like a difficult job that requires considerable judgment and the use of many estimates.
Yes, that's certainly the case. IAS 29 even acknowledges this and states that consistent application is more important than precise accuracy. It's also worth remembering that IAS 1 requires disclosure of significant judgments and estimates, and so additional disclosures around these may be required.
Thanks, Jane. Moving on to the next slide. Now we're going to look at steps to apply hyperinflation accounting. So next slide, please, and over to you, Jane.
Thanks, Lucy. The restatement of financial statements in accordance with IAS 29 requires the following steps. First, a general price index is selected. Then the statement of financial position is restated, followed by the statement of changes in equity and the statement of profit and loss and other comprehensive income. This step will also include the calculation of a gain or loss on the net monetary position. And finally, the statement of cash flows is restated. IAS 29 is applied retrospectively. As a result, current year figures are in some instances dependent on comparatives, and therefore these steps are first applied to the opening balances of the prior year, then the prior year's transactions and balances before the current year figures are considered. As we will explain later on, this is more complex in the first year of application, but a fairly easy process in subsequent years.
Thanks, Jane. Let's soon move on to look at that first step of selecting a general price index and moving to the next slide, please. Now, Peter, can you talk us through step one, please?
Sure. The standard requires the use of a general price index that reflects changes in general purchasing power. And generally, this is usually the Consumer Price Index, or CPI. And ideally, all entities that report in the same hyperinflationary currency use the same price index. Now, on the slide, we list important characteristics that a good general price index should have. And first of all, the general price index should cover a wide range of goods and services. There should be continuity and consistency of the measurement techniques and underlying assumptions. It should be free from bias, be frequently updated, and available for a long period. And finally, it should reflect currency-wide rather than regional purchasing power. The entity should use the above criteria to choose the most reliable and most readily available general price index and use that index consistently. In this presentation, we assume that the CPI is the general price index. Next slide, please.
Thanks, Peter. Now in step two, we look at the restatement of the financial position. So moving on to the next slide. So in earlier examples, we discussed how land under the cost model is restated. Sinem, are assets and liabilities required to be restated?
Yes, Lucy, assets and liabilities are required to be restated from when they were last measured at current cost. Some items will be remeasured to current values at the reporting date and therefore won't require restatement. To identify which items need restatement, we distinguish between those that are monetary or that are measured at current price and therefore do not require restatement, and those that are non-monetary and measured at historical price and therefore require restatement. Monetary items such as cash, debtors, and loans are already valued at amounts showing the purchasing power of the local currency, so these would not need to be restated. There are also some non-monetary items that are carried at current price, such as investment properties that are revalued, and these would not need to be restated for hyperinflation. However, non-monetary items that are carried at historical price do need to be restated, as their carrying value would not reflect the current purchasing power. Distinguishing between monetary and non-monetary items may be very complex and requires judgment. One example would be a warranty provision, which could be either monetary or non-monetary, depending on whether the customers have a right to a refund or a right to a replacement of any defective product. If customers can choose between a refund and a replacement product, then the balance might be partly monetary and partly non-monetary. So look out for gray areas. International GAAP has good examples of such items and also discusses the accounting considerations for inflation index linked items. Next slide, please. Now let's take a look at the restatement process using a PP&E example. Entity A has a year-end of 31st December 2023 and has two assets, an office building which was purchased in 2021 and the warehouse purchased in July 2023. Both assets have a useful life of 10 years. Entity A applied IAS 29 in the previous reporting period, which is 31st December 2022, and has calculated the restated carrying value at this previous reporting date. Next slide, please. Now, let's take a look at the steps required to restate PP&E for the current year in 2023. Starting with the opening balance. Where IAS 29 was applied in the comparative period, this will be a straightforward mathematical computation to apply the measuring unit current at the end of the reporting period to the prior year comparative figures. So the opening balance is restated by adjusting the balance reported per IAS 29 in the prior period for the increase in the price index between the beginning and end date of the current period. Then Entity A needs to restate the warehouse that was acquired during the reporting period for the increase in price index from the purchase date in July to December. Previously calculated depreciation is not restated by simply applying a conversion factor to the current year depreciation charge, but rather it is recalculated using the cost balance restated for hyperinflation on an asset-by-asset basis as a starting point. So the restated cost price is used to calculate the current year depreciation expense. Lastly, the closing balance is in practice determined by adding up restated opening balance plus additions minus depreciation.
Thank you, Sinem. Moving on now to slide 22. Now that we have restated the closing balance, Sinem, can you explain what entities need to do next, please?
Sure, Lucy. Once the carrying value is restated, additional adjustments may need to be made. In order to arrive at the final restated cost of the non-monetary items, the provisional restated cost needs to be adjusted for borrowing costs and impairment. Borrowing costs that compensate for inflation are removed to avoid double counting the effect of inflation that is already included in the borrowing costs. Then one needs to consider if the restatement process has resulted in the non-monetary asset being stated above their recoverable amount. Therefore, IAS 29 requires that the restated amount of a non-monetary item is reduced to its recoverable amount in accordance with the applicable standard, which is IAS 2 for inventory and IAS 36 for most of the other non-monetary assets. Some line items that do not use this approach and that are more complex to adjust for inflation include equity accounted investments, deferred tax, and warranty provisions. We will touch on deferred tax briefly here, but please see International GAAP for guidance for more detail.
Thanks, Sinem. Before we get to deferred tax, let's debrief polling question number 1 on the next slide. Now, as a reminder, this question asked what the expected financial impact of the application of IAS 29 at a group level would be if a subsidiary has a hyperinflationary functional currency. Now, we had about 36% people answering A, which was material, and the rest of the responses are really pretty much spread between D, not yet determined, and E, not applicable. Peter, can you elaborate on these polling results, please?
Yeah, of course. I mean, IAS 29 obviously applies to the numbers of the subsidiary in the hyperinflationary economy, but that very often has quite a big impact on the consolidated financial statements. And that one of the reasons is that you have this catch-up effect on PP&E that Jane just described, but also on goodwill, for instance. And also the effects on revenue, gross margins, and tax are quite significant in many cases. Now, obviously, there's a bit of self-selection in the audience that those who are most affected are probably most interested in this webcast. But yeah, it is actually quite impressive how material this is.
Indeed. Thanks, Peter. So let's move on now to our second polling question and the next slide. So this polling question asks, does the closing balance of an investment measured at fair value need to be restated for IAS 29 purposes? And your options there are yes, no, or C, I do not know. So as usual, please decide which of those statements you think is most appropriate and submit your answers to us, and we will come back to the results of the poll in a few minutes. Moving now on to slide 25. So deferred tax was mentioned earlier as one of the more complex line items. Peter, what do entities need to consider when restating the deferred tax balance?
Well, first of all, it's important to know that the measurement and recognition principles of IAS 12 continue to apply under IAS 29, but they are subject to the IFRIC 7 guidance for entities in hyperinflationary environments. So that means that entities should calculate temporary differences and deferred tax based on the restated asset and liability balances. Now, the application of IAS 29 may give rise to temporary differences when equivalent adjustments are not allowed for tax purposes, but also on items where the tax base was equal to the carrying value before application of IAS 29. Now, the IAS 12 principles as to where the movement in deferred tax is recognized is also applied under IAS 29. So they are recognized in P&L for most items restated under IAS 29, but for items that are both revalued and restated, the tax related to revaluation is recognized in OCI, while other movements are recognized in profit or loss. Next slide, please. Now, on this slide, we see the historical costs and IAS 29 calculations of temporary differences for inventory, PP&E, and equity investments. The tax bases are determined in a consistent manner under IAS 29 and therefore are equal in the historical and IAS 29 calculations. Now, in the case of inventory, there are no deferred tax balances before applying IAS 29, but the restatement process gives rise to a temporary difference and therefore deferred tax. For PP&E, the temporary difference on restated assets is typically higher than before applying IAS 29, while the temporary difference on equity instruments remains the same as there is no IAS 29 restatement.
Thanks, Peter. On the next slide, please could you take us through how to perform a reasonability check?
Yes. If we compare the numbers in the grey boxes on the slide, you can see that monetary items in the current period, 2023, are not restated and remain at their historical values. And similarly, looking at the yellow boxes, it can be seen that non-monetary items measured at current cost are not restated either and remain at fair value. Next slide, please. Now, comparing the numbers in the grey boxes on this slide, you can see that monetary items in the comparative period, 2022, are restated by applying the one-year inflation factor for 2023, which is 1.5 in this example. Next slide, please. And then comparing the numbers in the grey boxes on this final slide, you can see that non-monetary items in the current period, 2023, are restated and that older items, such as PP&E, are adjusted for a higher inflation factor. And finally, looking at the yellow boxes, you can see that deferred tax has been recalculated under IAS 12, and that in this case, the majority of the increase is actually driven by PP&E. Next slide, please.
Thanks, Peter. Now, let's move on to step 3, where we will have a look at the restatement of the changes in equity. And I see that slide number 31 is up. Sinem, could you please explain how an entity restates the statement of changes in equity?
Sure. In the year IAS 29 is first applied, the opening balance of retained earnings in the comparative period needs to be calculated. To do this, the components of owner's equity are restated by applying a general price index from the date the components were contributed or otherwise arose. Next, revaluation surpluses are eliminated and retained earnings are derived as the balancing figure from all other restated amounts in the balance sheet. Next slide, please. At the end of the first reporting period and in subsequent periods, the opening balance is restated for the movement in the inflation index for the period, while total comprehensive income is taken from the restated statement of comprehensive income, and all other equity transactions are restated from the transaction date. While it's not shown here, subsequent revaluations may give rise to a revaluation surplus within equity.
Thanks, Sinem. Next slide, please. Okay, next up, we will continue with the restatement of comprehensive income. Sinem, can you take us through the slide after this one, please, which is number 34? Thank you.
Sure. Let's now look at the restatement of the profit or loss items. IAS 29 requires that all items in the statement of comprehensive income are expressed in terms of the measuring unit current at the end of the reporting period. Therefore, all amounts need to be restated by applying the change in the general price index from the dates when the items of income and expenses were initially recognized. That is, from the dates when the items of income or expenses were initially recorded in the financial statements. For practical reasons, this may require the use of a monthly price index to restate income and expenses. However, for those profit or loss items that are derived from the previously recognized assets and liabilities, the restatement starts with the restated amounts in the statement of financial position. For example, depreciation and amortization are calculated based on the restated asset balances. Similarly, the movement in deferred taxes takes into account the restatement of the underlying assets and liabilities, which affect the temporary differences. Lastly, the closing carrying value of items measured at fair value would already be at current value, but as their opening balance would be restated for hyperinflation, the movement in fair value is restated to reflect the difference between closing fair value and a restated opening balance sheet. Next slide, please. Now, this slide uses revenues to illustrate the general rule as transactions happen throughout the period and sales prices are current at the end of at the date of sale. In theory, each individual transaction should be restated from its transaction date, but it is not practicable, not least because inflation statistics are often not available in this level of detail. Here we assume that revenue is spread evenly within the month, and this level of disaggregation is appropriate. The inflation index as of 31st December, being the year end, is taken as a basis for calculation, so it equals 1. The inflation index for the end of each month is used to drive the conversion factor for the end of that month. As transactions happen throughout the month, an average conversion factor is used to restate each of the months. Before restatement, the revenue in February and December was equal, but after restatement, as expected, 7,000 in February represented a much higher value. As demonstrated on the slide, the restatement of revenue is relatively straightforward. Jane, can you now take us through the restatement of some of the more complex items on the next slide?
Thanks, Sinem. IAS 29 notes that most non-monetary items are carried at cost or cost less depreciation. Hence, they are expressed at amounts current at their date of acquisition. Each item, therefore, needs to be restated from its historical cost or cost less depreciation by adjusting it for the change in the general price index from its date of acquisition to the end of the current reporting period. Let's look at the following example in which we restate inventory for inflation after its acquisition date and the impact that this has on cost of sales. In this example, the entity sells the inventory purchased as is. There's no production involved, so inventory only comprises finished goods. The calculation of cost of sales is based on opening and closing inventory balances and purchases for the year. To calculate the cost of sales, as restated under IAS 29, each of these inputs to the calculation must be restated to the monetary unit present at the reporting date. The opening balance, the closing balance, and purchases are all restated using the applicable conversion factor in the middle column. The cost of goods sold is then determined as the balancing figure. This approach ensures sold items are reflected as restated from the purchase date rather than the date of sale. Next slide, please. Moving on to consider movements in fair value. Here, we look at some more examples that do not follow the general rule that Sinem discussed earlier. Assume a financial instrument with a historical cost of 1,000 and a closing fair value of 1,800. Depending on the type of instrument, the fair value gain or loss in the period will be different. If it is an equity instrument, which is non-monetary, our approach is the same as for other non-monetary items. Firstly, there is no monetary gain or loss, and secondly, the fair value gain or loss is equal to the difference between the restated opening balance and the closing balance at fair value. If it is a debt instrument, however, two approaches are possible for the determination of the fair value. On the one hand, an entity could assume that the increase in fair value gradually arose over the course of the year, and therefore restates fair value movements based on an average CPI factor for the year. Alternatively, an entity can argue that the fair value was remeasured at year-end, and hence a conversion factor of 1 should apply. In both cases, the monetary gain or loss is determined as the balancing figure. IAS 29 does not prescribe a specific approach, but it is crucial that entities apply the selected approach consistently. Next slide, please. Now let's take a look at some more reasonability checks. Here we compare the IAS 29 restated financial information to that prior to the restatement process. We expect income and expenses earned or incurred throughout the year to be restated from transaction dates. So they will be generally higher by a factor that would approximate an average inflation for the year if transactions indeed occurred evenly throughout the year. However, depreciation is restated from the acquisition date of the asset, so we typically expect this amount to be significantly higher than the 1-year inflation factor. Next slide, please. Fair value movements can be tricky to sense check because the measurement will be highly dependent on whether the item is monetary or non-monetary, as we discussed earlier. In this case, with a non-monetary asset, the adjustment of the opening balance for inflation results in a higher carrying amount as the starting point, which would decrease a gain or increase a loss. It's also worth noting that depending on the makeup of the net profit figure, it's possible for the net profit amount to be lower than the historical figure, or even a loss when historical results reflect a profit. Over to you, Lucy, to debrief polling question 2.
Thanks, Jane. Moving on to the next slide and also the polling results. So we can see there we've got about 50% nearly of people who said yes to the question, which asked, does the closing balance of an investment measured at fair value need to be restated for IAS 29 purposes? And the remainder of the responses were split between no and I do not know. So, Jane, would you like to say a few words on that result?
Investments measured at fair value are at an amount showing a current purchasing power. So there would be no need to restate this, and the correct answer is in fact no. Thanks, Jane.
So let's move on to the next polling question. Polling question number 3 concerns the profit or loss items and asks, would all of the following profit or loss items be restated? That is revenue, cost of goods sold, depreciation, using the average consumer price index for the period in which they were expensed. So there are three options for you here: yes, no, or I do not know. So as ever, please decide which of those options is correct and submit your answers, and we will come back to the results of the poll in a few slides' time. Let's move on to slide number 42 now. We're going to look at the calculation of the gain or loss on the net monetary position. So next slide, please, and over to you, Peter.
Thank you, Lucy. The gain or loss on the net monetary position, that has to be included in profit or loss, and it needs to be presented separately. And it is in theory calculated first by analyzing the items that cause changes in the monetary assets or liabilities. And then the net monetary gain loss is estimated by applying the change in the general price index to the net amount of monetary assets and liabilities. Now, in most companies, there are a very large number of monetary transactions that affect the net monetary position. So calculating the gain or loss on the net monetary position at the transaction level is wholly impracticable given the amount of information required. However, IAS 29 allows the net monetary gain or loss to be estimated by applying the change in the general price index to the weighted average net monetary assets and liabilities for the period. The net monetary gain or loss is therefore calculated as the product of the average monetary position per month or per quarter or per week times the change in the general price index for that period. This approximation is likely not to be entirely accurate given the level of estimation and aggregation required. Next slide, please. Therefore, in practice, entities usually first restate the non-monetary items. As we can see from the equations presented on the slide, mathematically, the restatement of monetary items is the equal and opposite of the restatement of the non-monetary items. So the restatement of non-monetary items can be used as the basis for determining the net monetary gain or loss as described on the next slide. To calculate the monetary gain or loss using that default approach, an entity takes the restated non-monetary items, all balances and transactions as described earlier, as a starting point. However, at this point, the statement of financial position, taking into account the profit or loss as restated so far, will not balance. And the monetary gain or loss is then determined as the additional profit or loss that needs to be recognized in retained earnings in order to balance the balance sheet. While this approach results in the most accurate calculation, it should be checked with a separate monetary gain-loss calculation as explained on the next slide. Now, here is a simple example of a calculation of the monetary gain or loss in an entity assumed to have no operations and only cash and share capital on its balance sheet. In historical currency units, the balances stay the same throughout the year. And what we do is first we analyze items that cause monetary gains or losses. In this case, the only monetary item is the cash balance. Second, we then calculate the weighted average amount of monetary assets and liabilities. In our example, it's only cash. And as there is no movement, the average monetary position is 10,000. We then multiply this amount by the change in the conversion factor. That is the conversion factor at the beginning of the period minus the conversion factor at the end of the period. The difference, as seen in the calculation presented in the slide, equals the monetary loss in the statement of changes in equity. Now, the above example is obviously very straightforward and oversimplified, and in real life the process will be quite complex and subject to significant estimation. If the outcomes of these two approaches are significantly different, something has gone wrong, and both calculation methodologies should be rechecked, and it may, for instance, be necessary not to use quarterly averages, but go to monthly or weekly averages. Next slide, please.
Thanks, Peter. So looking at slide number 47, we are now going to cover the topic of a restatement of the statement of cash flows. So if we could move over to the next slide, please. Now, the restatement of cash flow statement is not as straightforward as you would expect. Sinem, could you explain to us the approaches an entity would need to take?
Sure, Lucy. IAS 29 requires a statement of cash flows to be expressed in terms of the measuring unit current at the end of the reporting period. So restatement of the cash flows may result in amounts disclosed not being equal to actual cash flows. In practice, we see this monetary gain loss can be presented in the statement of cash flows in 3 different ways, which we will focus on the next slide. These options are not specifically stated in IAS 29. However, these methods have been identified as those applied in practice. Entities should disclose the chosen approach in their accounting policies. Besides, entities that have a significant proportion of their activities in hyperinflationary economies should consider whether they should provide additional disclosures to ensure that the financial statements are fully understood. Whether this is limited to a general explanation of the mismatch between reported and actual amounts or specific information on major transactions would depend on the nature and materiality of the transactions affected. Next slide, please. Now, this slide demonstrates the 3 approaches mentioned on the previous slide. Under approach 1, the cash flows line items will be non-restated numbers, and the effect of inflation is presented separately for operating, investing, and financing activities, as well as for cash and cash equivalents. Approach 2 is similar to approach 1, but the inflation effect is presented as a single line in the cash flow statement. Approach 3 differs as the cash flows for each line item are restated from the transaction date and do not correspond to the actual cash flows. The inflation effect on cash and cash equivalents will be shown as a reconciling item.
Thank you, Sinem. Moving on to slide 15 now. As we mentioned earlier, IAS 29 requires retrospective restatement, which includes the restatement of comparative figures. Coming back to you, Sinem, can you take us through the next slide, please?
Okay. When the functional currency of an entity becomes hyperinflationary, it must apply IAS 29 fully retrospectively, meaning the standard is applied as if the economy had always been hyperinflationary. This means entities need to restate 3 balance sheets and 2 income statements to get to the figures to be reported in the year of initial application. Effectively, entities need to build up the comparatives first before they can apply IAS 29 to the current year. To start this process, the opening statement of financial position at the beginning of the earliest period presented in the financial statement, in this case, 1st of January 2021, should be restated using the principles explained earlier in this presentation. Next, the financial information for 2021 is restated by restating the 2020 balance sheet to the monetary unit current at 31st December 2021, applying IAS 29 to current year figures to establish what would have been reported under IAS 29 for the comparative period. Finally, to determine the amounts to be presented as comparative at 31st December 2022, the amounts determined as at 31st December 2021 are restated by a factor of 1 year, that is the monetary unit present at 31st December 2022. Next slide, please. In subsequent years, the restatement of the period is considered easier, as the financial information reported in prior year is also stated in the monetary unit present at that date. The same factor being in pre-inflation for the year is applied to all amounts as previously reported. It is important to note that all corresponding figures for the previous reporting period, whether they were based on historical cost approach or current cost approach, are restated by applying that general price index. And information that is disclosed in respect of earlier periods is also expressed in terms of measuring unit currents at the end of the reporting period.
Thank you, Sinem. Moving on to the next slide now, let's have a look at the debrief of polling question number 3. Now, as a reminder, this question was about the restatement of the profit and loss items, namely if the average consumer price index would be used for the restatement of revenues, cost of goods sold, and depreciation. Now, almost half of the respondents chose A, which was yes, and the remainder was split between B, which is no, and I do not know. So, Sinem, would you like to say a few words on the results of that poll?
Yes, dear Lucy. While at a first glance it might seem logical to apply an average consumer price index to all, actually this is not the approach for all profit and loss items such as depreciation, cost of goods sold. So in this case, actually the correct answer is B, which is no, because depreciation and cost of goods sold should be indexed differently.
Thanks, Sinem. Now, next slide, please, and let's have a look at our final polling question. So you all have another go to try and get this one right. Our fourth polling question asks whether a non-hyperinflationary parent restates its comparative information in its financial statements when one of its subsidiaries first applies IAS 29 in the current year. So not a difficult question at all. Okay, there are 3 options here, either yes, no, or it is a policy choice. So please decide which of those options on the slide is correct, and then you can submit your answers to us, and we will come back to the results of the poll in a few minutes. Right, next slide, please. In this final section of our webcast today, we will discuss the consolidation of a hyperinflationary subsidiary by a non-hyperinflationary parent. So Jane, can you take us through the next slide, please?
Of course, Lucy. So we're going to compare how IAS 29 affects the financial statements of a hyperinflationary entity compared to how it affects the financial statements of its non-hyperinflationary parent. The hyperinflationary subsidiary would need to restate comparatives in all periods where IAS 29 applies. In the first year of application, the subsidiary would apply IAS 29 retrospectively, restating items from the transaction date to the monetary unit present at the current reporting date. In subsequent periods, the comparative numbers are then adjusted for inflationary increases since the comparative reporting date. In both cases, the IAS 29 restatement effect would be recognized in the opening equity of the earliest period presented. In contrast, for the non-hyperinflationary parent's consolidated financial statements, comparative information is not restated. There's the answer to your polling question, and remains as reported previously. As the parent does not restate its comparative periods, it recognizes the IAS 29 restatement effect on the opening balances of the subsidiary, either in the currency translation adjustment in other comprehensive income or in equity. We will discuss this in more detail shortly. Both the subsidiary and its parent would recognize a net monetary gain or loss in the current period. Because the subsidiary restates its comparative figures, a net monetary effect would also be present in the comparative period when it first applies IAS 29. This is different than for the parent, which does not restate its comparatives as a result of the application of IAS 29, and therefore will only have a monetary gain or loss in the current period. In subsequent periods, as we said before, the subsidiary will restate all comparatives by the inflation factor since the last reporting date, including the monetary gain or loss, while in contrast, the parent will not change the amounts previously reported. Next slide, please. On this slide, we consider the steps required to consolidate a hyperinflationary subsidiary into a non-hyperinflationary group, using an example of a euro-denominated parent which owns a hyperinflationary subsidiary. The subsidiary must first restate its financial statements in accordance with IAS 29. When incorporating these IAS 29 results into the consolidated group, the parent must apply IAS 29 principles to the adjustments arising at the time of the acquisition. For example, goodwill is restated from the acquisition date, and the last remeasurement date for historical cost items is also the acquisition date, as these would have been measured at fair value on this date. The parent applies the closing rates to all amounts in the primary financial statements. In addition, the parent should determine the appropriate classification of currency translation adjustments and inflation adjustments between other comprehensive income and equity. Next slide, please.
So, Jane, how does one determine the appropriate classification of currency translation adjustments and inflation adjustments between OCI and equity when consolidating a hyperinflationary foreign operation? Can you take us through the accounting considerations?
For non-hyperinflationary foreign operations, all exchange differences on translation should be recognized, as we know, in other comprehensive income. However, IAS 21 does not specifically require the same treatment for hyperinflationary foreign operations. The IFRS Interpretations Committee discussed this and concluded that entities should present the IAS 29 restatement effect and the IAS 21 translation effect in other comprehensive income, or the IAS 21 translation effect in other comprehensive income if the entity considers that only the translation effect meets the definition of an exchange difference in IAS 21. In this case, the entity presents the IAS 29 restatement effect in equity. We know, though, from practice that separating the IAS 21 and the IAS 29 effects can be difficult. Also, we note that upon disposal, only the amount recorded as a currency translation adjustment in OCI can be recycled to profit or loss. Peter, can you please take us through the example on the next slide, please?
Yeah, so let's look at a simple example. Here we have a subsidiary with a historical opening net assets balance of 1,000, which was translated using last year's exchange rate of 10 and consolidated into the group financial statements at 10,000. Applying IAS 29 principles, the restated opening net asset balance reported in the subsidiary's own financial statements is 1,300. The restated net profit after tax is 100, and the restated closing net asset value is 1,400. Both are translated using the closing rate of 8 on reporting date. The total of the currency and IAS 29 adjustments combined is 400, which is calculated as C minus B minus A on the slide. That is the closing net asset value minus the net profit after tax minus the historical translated opening balance. The IAS 29 restatement reflects the restatement of the opening balance translated at last year's closing rate, and the IAS 21 foreign exchange translation effect is calculated by multiplying the restated opening net asset value by the difference between the closing and opening exchange rates. However, given that there is a degree of interaction between the devaluation of a currency and inflation rates, making this separation is not as clear-cut in practice. Next slide, please.
Thanks, Peter. Can you also explain, please, what the impact would be for quarterly reporters when a subsidiary becomes hyperinflationary during that quarter?
Well, there are a number of complications for interim reporting that entities should be aware of, but in the interest of time, I will just note that anyone finding themselves in such circumstances should refer to Chapter 16 of International GAAP for more detail on those issues. Thanks,
Peter. Next slide, please. Here we're going to debrief polling question number 4, which asks whether a non-hyperinflationary parent must restate its comparative information in its financial statements when one of its subsidiaries first applies IAS 29 in the current year. Now, the results show that 40-odd% of you chose yes, 20-odd% of you chose no, and the rest said it was a policy choice. So, Peter, would you like to say a few words on this result?
Well, as Jane discussed earlier when she presented the slide with that table, IAS 21 prohibits the restatement of comparative figures when the presentation currency is not hyperinflationary, and so B is the correct answer, and comparative amounts are not adjusted.
Thanks very much, Peter. So next slide, please. We have received one question from the audience, which we thought we might deal with now, which is, what are the reporting implications when CPI statistics are only available well after the reporting date? Peter, do you want to address this one?
Yeah, this is actually a very common problem. I mean, if you have a country like Turkey, they will report the CPI on the third working day of the next month, whereas in the case of Sri Lanka, they will report it 3 weeks into the next month. And that means that if you need to close your books, you're on the horns of a dilemma, because either you're going to wait 3 weeks, and you may not have that time, or you will actually be required to make an estimate of the closing CPI and use that.
Oh, I see. Thank you very much. Good question. Thanks. Let's move on now to our 1-minute recap on slide 63. So we've, as always, had a really good discussion today, but we are kind of approaching the top of the hour. So we're now going to provide you with our 1-minute recap of this webcast. So, Sinem, would you mind going first and sharing your key takeaway, please?
To me, categorizing balance sheet items into monetary and non-monetary can be complex and have pervasive implications on the financial statement. So it needs to be adequately addressed before the restatement process can begin.
Thanks, Sinem. And Jane, what would be your key takeaway?
A significant deal of judgment and estimation is required in applying IAS 29, so consistency should be prioritized over accuracy, and significant judgments and estimates may need to be disclosed to explain to the users of the financial statements the impact of these judgments and estimates.
Thanks, Jane. Peter, anything you'd like to add?
Yeah, the one thing I would like to add is that it's important not to underestimate the complexity in consolidating hyperinflationary subsidiaries, because the parent needs to apply IAS 21 currency translation requirements on top of the IAS 29 restated numbers, and the requirements for the parent are slightly different from those for the subsidiary.
Thanks very much. Right, let's move on to the next slide now, please. So here we can see the objectives of this webcast that were listed. Hopefully we've achieved those for you today. And as we mentioned earlier, the slides are available to participants in the resources icon. Let's move on now to slide 65. Now, as you can see on this page, the resources that are available to you on the EY IFRS page to keep you up to date. For external participants, please also note that this year, International GAAP is now available free of charge on ey.com/atlas. So there's a lot of good material there that you can have a look at on that slide. So let's move on to the next slide now. This webcast, as usual, is one in a series of our executive update webcasts. And on the slide, you can see that some of our recent webcasts are listed too. We've got the Global Executive Update on sustainability, and we've got an update on what to know about cloud computing costs. So it's something really worthwhile going in and having a look at those archives and listening into those webcasts just to catch up, keep yourself updated. Moving on to the next slide now, it's just a reminder here really to continue your dialogue on these topics that we've covered today. We do notice that, you know, a lot of people find this a very challenging area. We understand that, which is why we thought this webcast would be useful to you. So we really do hope that it was. Any upcoming webcasts that we have planned will be announced via LinkedIn, as usual, for external attendees, and also, of course, in global ANA news for our internal people. And moving on to our final slide then, please. I just want to say thank you to our presenters for involvement and insights today, and also thank you to our audience for your participation and for your valuable input. We hope that it's been helpful, as I said, and we know that you had some questions. We didn't have time to get to all of them, unfortunately, but we will review them and we'll try to address the recurring themes in our upcoming webcasts and our publications. Just a reminder also to submit your feedback for this session. So thank you for attending our webcast today. I am Lucy Wright, and it's goodbye until the next time.